Ruchit Jain too joins in to talk about what his reading is on the markets. Ruchit, hi, afternoon. Great to have you on the show as always. Ruchit, a couple of these movers, and tell me what you see on the charts for a K-Fintech and for a Laurus Labs.
I think Laurus, no doubt, no, it's not just today's move, but if you look at last few months, it has been a consistent outperformer within the pharma space. Now, the stock has not even closed below its 20-day EMA since a few months. So this clearly indicates a strong trended phase going on in the stock. So we believe that this uptrend could continue because post numbers reaction, if you see, that has been supported by good volumes, even in spite of the recent up move that we have seen. So Laurus can continue its uptrend. On the higher side, we can expect levels around 1900, 1950 in the short term. Even K-Fintech, I think overall the stock has been a laggard where we have seen some consolidation in last few months, but the stock has already gone through a price-wise as well as time-wise corrective phase. And this reaction post the numbers that too with very good volumes that we have seen today, this could lead to a renewed buying interest in the stock. So I think 1020, 1050 is kind of the levels where one can expect K-Fintech on the higher side in the short term.
Okay. Ruchit, just trying to get your sense on IT in general. How are you looking at that pack now?
So yes, last 15, 20 days, we have seen a price up move in many of the IT names. So as of now, it seems that we have already seen price-wise corrective phases behind us for the IT names. Now the trend seems to be changed from downtrend to sideways. So this could be more of a time-wise corrective phase for the IT space. On the higher side, 30,000 is where the immediate trendline resistance for the Nifty IT index would come in. So that's where we could see some resistance. But either the kind of weekly and the monthly setups that many charts have made, we are of the opinion that the price-wise worst phase is over for the IT names, but we could see some time-wise correction or consolidation in the broad range, at least for next 1 or 2 months. Maybe then we should see a good resumption of the move. But for next 1 or 2 months, I think it would be more of a time-wise correction for IT.
Okay, Eternal, that's the one which has been holding up very well today. There has been some chatter around, the valuation which is being ascribed to Zepto in the grey market. Eternal bumping up a good 5.5% as we speak right now. And Swiggy, which also had a rough Friday, that also should come up for you on your screens. That too is rebounding, now holding up 3%. Kunal, just reiterate the charts of what you foresee now for an Eternal and a Swiggy and whether they can bounce up further from here.
Yeah, I think both these stocks should bounce back further because, what's happened is for Eternal, for example, the stock has come back towards a fourth test around this 295 to 300 zone in the last 1.5 odd month. Multiple tests towards a particular resistance generally leads into the resistance in breaking out. So I believe this time around the stock should be able to break past above the 300 levels and surpass those moves on the higher side. So I would be looking at least 325, 330 as a potential positional target for Zomato. Swiggy, on the other hand, I think after that sharp correction post the news flow last week for the stock price, it's good to see that the stock is seeing some bit of a bounce back. But I'll just wait for maybe another couple of days to what happens many a times is that after a sharp correction or a cool off into the stock prices, there is an immediate knee-jerk bounce back into those stocks, but then they hardly see any major follow through in the subsequent next couple of days. So we'll wait for Swiggy to try and show a further bounce. Because if that happens, then we could be looking at a big turnaround and not just a retest to that 265, 275 mark for the stock.
Okay. All right. So that's really the tilt. The other one in focus is even a Laurus Labs. I mean, the move has been extremely strong. And we spoke with management, very, very confident sounding management of Laurus Labs. In fact, listening to a slice of what the guidance is.
The majority capex, what we intend to do will be around small volume APIs, mostly drug substances, and partly also drug product facility expansions. Some general capex also we will do. Our acquisition of 500 plus acres land is nearing completion. So we'll also start investing in general capex at that stage. That will happen. May not be in this financial year, maybe mostly happen in the next financial year. What we can say, and also we are confident, we will maintain 60+% gross margin and 30+% of EBITDA margins for the entire financial.
Okay, that's that on Laurus Labs, and that stock, of course, holding out very well. Just want to revisit a couple of other names. While heavyweights like Reliance, HDFC, Axis, Kotak continue to be under pressure, there's ONGC, of course, which is a big drag because of the movement on crude. But there's also a Bank of India, which is down about almost 4%. Though on the flip side, you are seeing a meaningful move come by on IDFC First. That's been the case in point from the word go. And come tomorrow as well, you've got some very interesting numbers lined up. You've got not just the Nifty expiry, but you'll have earnings from majors like Unilever and then, of course, L&T. For L&T, of course, the commentary on the international order book exposure is going to be extremely interesting. And then, of course, you've got others like a TTK Prestige, Ambuja Cement, there's Tara Capital, and many other companies which are slated for their numbers. I can see Radico Khaitan as well in that list of names, and Suzlon Energy as well. But Nishal Maheshwari joins in on the show right now to talk about what he's making of the market. Nishal, hi, afternoon. Good to be speaking with you as always. Nishal, stuck in that very wide range, at least for the index. That's where we've been sort of beating around. But what is it that you've made of the earnings quality so far?
Afternoon, Aisha, to you and your viewers. I think earnings this quarter has been better than expected. You look at it, all the financial institutions, I think the banks, the earnings have been pretty good. The recent numbers, basically, you've seen in pharma, I think that seems to be pretty decent. And similarly, we are seeing in terms of, in case of consumption. So I think overall, slightly better than expected.
Okay. How do you assess some of the mid and small cap banking earnings, Nishal? Some very strong numbers coming our way from that pack. Any favorites within that?
So private sector remains to be my favorite out there. I think IDFC has been phenomenal results yesterday. So a very good set of numbers. Similarly, I think Fed Bank also came out with very strong numbers. IndusInd also was pretty strong. So I think numbers across the whole financial sector has been pretty good. Though there has been some disappointment on the NIM side, but that was expected because since you were growing so aggressively and the majority of the growth is coming from the corporate side, some amount of pressure would be there on the NIMs. But credit growth has been very, very strong. And again, given the so much FCNR is getting raised, yesterday's, I think, RBI governor's number is $32 billion. I think it should end up somewhere between $60 to $80 billion. That's going to give, again, a liquidity boost to the banking sector. So I think the whole sector seems to be on a good spot.
In fact, come tomorrow, you'll have L&T as well report its numbers. Let me quickly take it across to Rabinder and find out what the ET Now poll is penciling in.
Well, as L&T is set to announce its Q1 FY27 earnings, and in this quarter, Street is estimating a muted set of number for Q1, and revenue is expected to see a growth of 6% on a yearly basis. But profitability is likely to remain under pressure, with companies' profitability is likely to decline 15% on a yearly basis, and the company's core E&C business is expected to post flat revenue growth on a yearly basis, and execution has been impacted by geopolitical disruption in Middle East and labor shortages in India, leading to a slower project progress, and as a result, the core E&C EBITDA margin is expected to decline by 40 basis points on a yearly basis to 7.3%. And on the order inflow, L&T is expected to secure 15,500 to 27,500 crore worth of order during the quarter, which is significantly ahead of the peers. And however, execution is likely to remain subdued as West Asia operations continue to face supply chain disruption, logistic delays, higher freight and insurance cost, and manpower constraint. And key management commentary will be closely watched out on the order pipeline and future inflow, the pace of execution recovery in domestic and international projects, demand trends in West Asia amid the ongoing conflict. So overall, Street is estimating a muted set of number for L&T in Q1.
Right, that's the expectation coming in from L&T. But just looking at the market texture right now, Eternal, Swiggy, both of those names, of course, are holding out well. I guess, Nishal, for Swiggy as well as Eternal, the big overhang now would be Zepto valuations, right?
So yes and no. So first, I want to make a disclosure. I am a holder in Eternal. But I think the interesting part is if Zepto is not able to raise the money basically at the kind of valuation it has been asking for, then definitely it has got a smaller kitty to go out and continue to do the discounting. Because if you really look at it, Zepto has been the most aggressive player in the market. And if that kind of a situation happens, I think it will be better for both the other players. So that's why you're seeing some uptick basically happening in both Eternal as well as Swiggy.
Okay, all right. Nishal, how else are you playing consumption? I'm curious, the kind of growth that Tata Consumer has clocked, for example. Nestle's numbers also very, very strong. And how does risk reward look in this space? Just kind of give us that sense.
So I think it's across the board basically. So consumption through financials, consumption through autos, consumption through FMCG as well as retailing. I think all the four sectors seems to be doing pretty well. And there are good specific plays in all of them basically. So I think across the board consumption surprisingly has been pretty strong and looks interesting at this point of time. So all the four sectors you can look at basically in terms of consumption.
Okay. Kunal, how are you looking at Tata Consumer and maybe some of the other consumption related plays? Let me throw in a Godrej, Nestle and the like.
See, these stocks are starting to show signs of recovery, but the pace of recovery for these stocks is very, very slow. Tata Consumers had gone through a huge correction, I think from 1240 plus levels recently towards 1080 mark, which was a sort of a lower support for Tata Consumers recently. In the same time frame, you look at the other names, Godrej Consumers, Britannia, Nestle, etc. I think these stocks had also gone through a mild bit of a correction. It looks like that broadly, I think many of these stocks are trying to make a very slow, gradual comeback. But with momentum lacking into these stocks on a consistent basis, you're bound to see a flip-flop move into many of these names for a few odd days. For example, just last week or so, or the start of the previous week, you had Nestle, which had broken past about 1500 levels or 1530 plus mark in a matter of 1 or 2 days. But then the stock has slipped back again to that 1430, 1450 levels today. So that tells you that that fragile nature of these stocks, where they're not being able to hold their breakouts, that I think could be something which could be a concern for a short-term view.
Right. Okay, that's the take coming in on the market right now. But Unilever is also due to report its numbers come tomorrow. We're expecting the revenue to grow at 6% on an annual basis, while the ice cream business demerger is going to drive the margins as well for them. Snehi is here to tell us what the ET Now poll is penciling in.
Well, yes, if you take a look at HUL's first quarter earnings, we're largely expecting to see a decent quarter from the company this time around. On a consolidated year-on-year basis, if I take a look at what the revenue expectation is, 17,516 crore rupees is what we are penciling in, which is an uptick of 6% on a year-on-year basis. This is, of course, after the demerger of the ice cream business, but if I had to count this on a like-to-like basis, then the revenue growth is expected around 9%. The EBITDA is seen higher by 7%. The net profit is seen at 2,800 crore rupees, which is an uptick of roughly 2% on a year-on-year basis. Let's talk about margins. Margins are expected to do really well. About a 40 to 50 bips tailwind is going to be seen in the margins this time around because of the demerger of the ice cream business, and that is going to play out. So margins over here, we are expecting at 23.1% compared to 22.5% this time last year. And remember, the management's guidance has constantly been between 22.5% and 23.5%. So this 23.1% number that we're penciling in is slightly on the upper end of the management's guidance and looking good on this front. Now, in terms of some other key expectations, our consolidated volume growth we're expecting to see at 6%, consolidated underlying sales growth expected at 3%. The company has also recently undertaken a 4 to 5% price hike, so we'll see what how the pricing action plays out. In terms of segments, home care is expected to grow 12% on a year-on-year basis, aided by price hikes across the portfolio. Beauty expected to grow 13%, personal care expected to grow by 6%, led by price hikes in soaps, and mid-single digit growth of roughly 8% is what we're seeing for the food segment. So lastly, when the numbers do come out, watch out for the management's commentary on growth outlook, margin guidance, if there is any revision over there at all, outlook on raw material prices, the El Nino impact, how they're expecting that to play out for the company, pricing outlook, any further pricing action, and update on the performance of the quick commerce segment, along with rural and urban demand, how the trends are shaping up. So yes, all in all, we're expecting to see a decent quarter from HUL for quarter one.
All right, that's on HUL. Ruchit, I wonder if you have a call on HUL very quickly.
Inbound trade for now. We have seen a time-wise correction over last few months, and there are no signs of any kind of trended phase coming in. Maybe post the numbers, if we see any kind of such reaction where the stock surpasses its important resistance levels, which is right now around 2200, 2230, then we can see a good trended move. But for now, the trend seems to be sideways.
Also curious to know, do you have a view on Concor, this kind of 7.5% kind of move today on the back of numbers and of course, very strong guidance. What's the view there?
Is that question for me?
No, Ruchit, that's for you. Sorry, just quick follow-up on Concor as well.
Okay. Yeah, so the volumes are quite good today. And already the stock has seen a correction over last few months. So the risk-reward ratio is definitely favorable for a good trended phase here. So even at current levels after today's 7% up move, I think with a stop loss below 480, traders can look for creating fresh long positions for positional view for possible targets around 560.
In fact, Concor has been soaring despite missing the street estimates in the first quarter. But the CMD Sanjay Swaroop spoke with us earlier today, and he says that the EXIM volumes will rise in the coming weeks and is sustaining their revenue guidance.
2,000 containers we have ordered, and most of them will be coming in this financial year. So this product has been very well received by trade and will give a big boost to our domestic business. Gunny bales traffic, which was not very good in the last financial year, now it is also picking up, and we are getting good demands in eastern India for gunny bales traffic. Thirdly, we are on the verge of signing a very big agreement with a big Maharatna company of Government of India, which is based in South India. From there, we will be getting very good business, and containers will be stuffed there, and they will be moved to Western India mostly. So we are around to garner around 1 million tons additional business as a result of this agreement. Then next is the assured transit train, which has been introduced by Indian Railways 8 months back between Delhi and Kolkata for domestic business with the stopovers at Agra and Kanpur. That has become a huge hit with trade, and we are getting very good business on this circuit. Indian Railways is going to announce another assured train very soon from South India to North India, which will give further boost to our domestic business. It's going to be a very good business, very interesting times, both in EXIM as well as domestic for our company. And now this is the time when I am going to revise my guidance that I gave at the start of financial year. So I am now revising the guidance of EXIM to 15% growth, domestic to 25% growth. Overall, it will be 18% growth for the company.
Well, today, of course, it's been IDFC First all the way, although the disappointment has come in from Bank of India. Nishal, you were talking about IDFC First performance, but last week started off same time with the private banks and their earnings that one reacted to over the weekend, out of which was it was only ICICI Bank which held out, and disappointment, trickled in for HDFC Bank, for Kotak, and Axis as well. Anywhere within banks where you've added positions after the earnings have come by?
So I hold IndusInd Bank basically, and that's where I added more positions basically. So though other banks, I have a position in HDFC, but I didn't add more positions out there. But I think going ahead, NIMS is, I think mostly is going to get bottomed out in the next quarter. And the credit growth is very strong if you really look at it across the sector. I think the credit growth, and with this, as I was telling earlier, with this $60 to $80 billion FCNR, I think there is going to be huge liquidity available to all these guys. So I continue to believe that this year is going to be very good for all these private sector banks.
Okay. Ruchit, how do you look at HDFC Bank on charts?
So still we have seen a relative underperformance in HDFC Bank compared to other private heavyweights. It is trading around its previous swing low supports. Last time the stock made a low of around 710 to 720. So on the downside, no price-based correction seems to be limited. Maybe if you get it in the range of 720, 710, the risk-reward ratio would become favorable to take some contra-trade risks. But no, again, this would be not one stock where no one should look from a very short-term trading perspective because of the absence of the trended phase in this stock. But more delivery-based buying can be done around 720, 710.
Okay. Ruchit, just very quickly, last off, taking a view on realty as a pack. Your favorites within that pack, very quickly.
Loda and Phoenix, these are two stocks which technically looks quite good. Loda, we have seen on this correction, the stock has taken support around its 20-day MA, and Phoenix Mills has been a relative outperformer over last few months. So I think in case of any continuation of the uptrend in the sector, both these stocks should do it.
Ruchit, we'll let you go. Thanks as always for joining in for your time today. But real estate, yeah, we've been talking about that. Kunal, you've been tracking the story for real estate from the March lows, right? What's looking like a good trade after the rebound that's already taken place?
Yeah, I think the entire sector looks quite strong. It looks like that we are now getting into that second
lap of an up move.
Second lap of an up move for the real estate pack, because initially it was led by very few names, like for example Oberoi Realty and Godrej were the ones which moved up first. Then it was followed by Prestige and some other names which had actually moved up higher. Then came a phase of the index consolidating, and then within that consolidation you saw the other names trying to pick up pace. For example, Loda started to pick up a good price action. Phoenix Limited has apparently been one of the best performers on the real estate stocks. And then the underperformers or so-called underperformers from the pack, the likes of DLF also made a comeback somewhere in between. So I think now we are looking at a phase where there could be a synchronized price action move across many of the real estate stocks. That's why it's going to be very difficult to try and pinpoint just maybe a handful, one or two names which could try and outperform over here, because I think this move could be led by a blend of both strong confidence built up into the real estate sector, and then the ones which have underperformed, even those stocks can try and play a good catch up. So I think for traders who are looking at a fresh buy, assuming at the current levels, you'll probably have to try and maybe pick up few individual stocks, or if you're looking to pick up a higher number of individual stocks in the sector, then your position size has to alter accordingly.
Okay, that's that on realty. In the meantime, Coal India is also due to report their numbers. Let me date across to Ashesha and find out what exactly are we expecting from Coal India.
Well, yes, we are expecting soft quarter for Coal India this time around, with revenue expected to decline by about 5% on a sequential basis. Although on a year-on-year basis, we are expecting consolidated revenues to rise by a solid 23%. Let's also talk about margins, because consolidated margins are expected to come in at about 28% versus 27.3% that the company had reported in the previous quarter. Now, remember, the company has already reported its operational data for the quarter gone by, where total supplies have risen by 4% YOY. We have non-regulated supplies which have risen by a solid 10% on a year-on-year basis, and power sector supplies are also expected to rise 2% YOY. Let's also talk about other factors which continue to remain at play, and let's start with realizations, because they are expected to rise not only for FSA but even for e-auctions, but this will be partly negated by higher input costs in the quarter gone by, and hence we are expecting a slight drop in the revenue on the sequential basis. Any kind of management commentary, especially with respect to volume pickup post-monsoon, will be very crucial. E-auction volume trend, e-auction pricing trend and FSA pricing trend will also be very crucial. But all in all, we are expecting soft quarter for Coal India this time.
Okay, a soft quarter for Coal India, and we've seen a bit of a correction in the stock price as well over the last couple of months. So that's also played out with regard to where Coal India is concerned. Auto Ank is the other play which has done well. In fact, was one of the rank outperformers last week. No meaningful or significant move, but an outperformance is an outperformance nonetheless. Nishal, any way in which you're playing auto, and maybe the hypothesis behind why so?
So I think two-wheelers is what though I do not have anything in my portfolio, but I think this is what I like in the moment, basically, because the exports on the two-wheeler front has been very, very strong. and the numbers have been pretty good in the last 2 months. And I continue to believe basically that India, the export numbers will continue to grow as we go ahead. Domestic market also basically we are seeing strong numbers coming through, and with the busy season coming around, I think definitely we are going to see strong numbers coming. So I'm playing through the two-wheeler and the auto ancillaries.
Well, the Defence Secretary has been quoted as saying that India is aiming to now reach a target of 50,000 crore rupees of defence exports by 2030 easily. So let me take it across to Avi and find out what is it that we are expecting from BEL's earnings this time.
So BEL is going to come out of this Q1 FY27 results on, and let's have a look at what we are expecting. We are factoring in a revenue of around 5,060 crore rupees, which will be a 15% growth on a yearly basis, with EBITDA coming in at around 1440 crore rupees, which will be a 16% increase, and profit coming in at around 1100 crore rupees, which will be a 14% increase on a yearly basis. So the revenue growth in the range of 12 to 16% depends upon the order execution that they are done. Considering the huge order book that they have of 7,400 crore rupees, the order inflow on a year-on-year basis can see a decline because of the high base of last year, and the product mix will determine the margins that BEL comes out with. Also, the strong revenue visibility that the company has on back of 7,400 crore rupees of order backlog. So the things to look out for will be the update on their huge orders like the Uttam radars, P751 and QRSAM. So these are some of the updates that will be something to look out for in the results, with the pace of execution against the large order backlog that the company has, and the incremental contribution from exports and the indigenization. So BEL will be on our radar with 1,100 crore rupees of profit and 5,060 crore rupees of revenue estimates at our end.
Okay, that's that on BEL. Having said that, for Zentek, of course, their earnings disappointment is quite sharply playing out on the stock. It was a gap down on it, and then a little bit of a rebound playing it from those session lows. But Nishal, curious to know, where is it that you find opportunities on defense, if at all, at these levels?
No, I think so. Basically, I think there are now good opportunities which have started coming in the defense. I've been negative for some time because of the valuation, not because there is no opportunity as far as the business is concerned. But I think the one number which I would say has actually once again created interest in the sector is basically that the number which Europe is now quoting, they presently spend around $200 billion a year. And in next 5 years, they are targeting that number to reach up to $1 trillion. So that is a kind of scale basically which the defense industry across the world is going to see. And you have to keep it in mind, basically, there are very few manufacturing bases across the world, China being out, obviously. So there are only a few countries which can help Europe reach that kind of scale. So I think India is very much up there. And we have to go back and look at the large players who have this kind of capacity to support Europe, who are well entrenched in the supply chains of Europe. That is very important, basically, because I don't think so Europe is going to buy anything directly from India in a completed form, but they are going to definitely look for cheaper sources of supplies. And I think Indian companies can really support them a lot. So we need to go back and look at all these stocks, but definitely there are opportunities now.
Kunal, are you spotting any opportunity within the defense pack on the charts?
Yeah, in fact, right now there are two names that are looking very attractive. HUL apparently is one of the stocks which I think is getting a good edge in terms of relative strength. The stock is nearing a break of 4,500, 600 barrier. And this could be a multiple breakout, series of a breakout for HUL, because the stock has been reeling into a downward sloping trend line since the last 2 years. And from that level of 5,000 plus where the stock was in 2024, every rally towards this trend line was taken as a resistance for the stock. And we saw major correction for HUL in that sense. So this could probably be a potential turnaround point for Hindustan Aeronautics. But then when you look at the defense stocks, other than the larger cap names like BEL, etc., there are so many stocks which have done very well for themselves. You look at MTAR Tech, you look at Azad Engineering. There are so many stocks which have done fabulously well over the last 6 months, 1 year, 2 years plus kind of a time frame. So the list is quite strong. Short-term wise, if I have to pick, I'll probably give HUL a slightly better chance in terms of a gaining leadership back again. But when the sector tries to pick up pace and when it gets into a breakout, we've historically seen that there have been slew of stocks in the entire defense pack which can perform very well. They have a knack of giving 20-30% in a matter of weeks or just a matter of a couple of months, at least looking at 2023-24 kind of rallies for these names. So it's a matter of time that whenever these stocks get into momentum, I think traders can try and jump onto those momentum kind of trades post that.
Okay, so that's the tilt. Nishal, I wonder how you're looking at some of the PSU banks, because that's one pocket which has again done fairly okay from a numbers perspective. But what next? I mean, for the next leg up, will more be needed, or can the current kind of run rate at which they're going sustain the kind of stock price action that we've seen in terms of outperformance?
So I think PSUs have run quite a lot. Basically, they have performed very well, both on the stock market as well as corporates. I think the numbers have been very good for PSUs. But I think here going ahead, there would be a challenge for them to grow at the same pace, because their deposits are not growing at the same pace as their advances. And I think that is going to be a challenge. And again, in this FCNR thing also, a majority of the money is going to be captured by the private sector bank, because they have a better network across the world. So I think I would prefer the private sector banks compared to PSUs, at least for the next 1 to 2 quarters.
What's the call on IT now, Nishal? Now that the big four are out of their earnings?
Sorry, which company?
IT as a sector, and would you say that the selling is now behind us?
So I'm turning incrementally positive on IT basically, and my thought remains to look at larger mid caps in that space, because there is definitely clarity which is coming as far as IT is concerned, both in terms of what role Indian companies are going to play in this new era, and how they will be able to pivot. So my thought process there is basically that the larger mid caps, they have the wherewithal, and they are not large enough to take more time to pivot. And that's why I own a couple of stocks out there, Persistent and Coforge. I think that's a market favorite also basically. Those are the 2 stocks basically in my portfolio at the moment.
Okay, that's quite interesting on IT. By the way, the Nifty has finally managed to cruise past that 24,000 mark. We've hit that level again.